Okay, so welcome to a series of lectures on adjusting journal entries. And we're going to start with adjusting the supplies account. And what we know is that the supplies account is an asset account, right? When we purchase supplies for our business, and if they're not going to be used right away and they're going to benefit a future period, that is an asset, a resource that we own or control that has a future benefit. So we buy the supplies today, more than we're going to use today, and we're going to use them over a period of time. So in this particular example, we have a supplies account that starts the year with a $300 debit balance. Well, they didn't exactly have to tell us that it was a debit balance. We would know that because it's a supplies account. If it has a balance in it and it's an asset, its normal balance is a debit. So we're going to use a T account when solving these types of problems, particularly if you're just learning adjusting journal entries. However, you don't have to use them. They're not mandatory. Sometimes it may make more sense for you as you get a little better at this not to use T accounts. But as you can see, I'm going to use one, and it looks like a giant T. We are going to indicate that this is our supplies account. And in our supplies account, above our T, we're going to put our debits on the left and our credits on the right. So this account has a $300 debit balance to start the year. So I'm going to mark BB for beginning balance and put that $300 over here on the debit side of the T account. Now they are telling us that no supplies, we didn't buy any new supplies during the year. We're going to do some other problems where we are purchasing supplies, but in this case we have not purchased any supplies during the year. We're just going to use what we have all year long. And then at the end of the year, on December 31st, we asked someone to go take a physical count, go take a look at what we still have on hand. They counted it and said, well, we have $110 of supplies that are still on hand in our supply closet. So if we are using the T account, the way we're going to use it is that in this case, what we know is we have a beginning balance of $300 and an ending balance of $110. And so we have to figure out how much, this is our question mark over here, how much of these supplies have we used during the year. If we started out with 300 and we ended up with 110, then that would indicate to me that we used $190 worth of supplies through the year. Another way we could do this is to say, well, what we have, what our balance is right now, our balance is $300. Our balance should be, I'm going to use SB for should be 110, and so therefore we need an adjusting entry for the difference of 190. So we could do it either in the T account or with a schedule like this. I like the T account because as we get a little more complicated with some of our adjusting entries, it does kind of help to see it visually. So let's just look at this T account for a moment. Back in Chapter 2, we learned about posting, and if we start out with the debit balance on the right, if we put if we put something over here on the credit side, I'm going to erase this for just a moment, and I'm going to erase my ending balance here for just a moment. Okay. And so if we started out with a debit balance and we credited this account by $190, well, what we know is we have debits on the left of $300, and we have credits on the right of $190. And what we want to do is subtract these two numbers, and our balance is wherever we have the larger number. So we're going to subtract 190 from 300. That leaves us 110. And we're going to put it on the debit side. Why? Because our debits are higher than our credits, so it's going to go on the debit side. All right, so what we know is we have an account. Let's repeat it. We have an account with a balance of $300 in it. And when we went and checked on the account, it should only have a balance of $110. And we have to figure out what gets us from $300 to $110. And we know that crediting that account by $190 we will end up with $110 left in the account. So then we need the journal entry. Well, what adjustment? We used these supplies, so we have the adjustment here on the credit side. And if we use supplies, and supplies is an asset, if we were to credit that asset right here, what does that make the asset do? Well, what we know is an asset goes up with a debit and down with a credit. So by crediting that asset, we are making that asset go down, and that's what we want to do because these are the supplies that we used during the year. So we used those supplies during the year. When we purchased them, we did not debit an expense and record an expense. Instead, we debited an asset. But we used the supplies. So now, according to our matching principle, if we use those supplies to generate revenue, we now need to recognize the expense. So let's go ahead and do that with the journal entry and see if this makes sense to you. Okay, so here's our journal entry down here. The date on this journal entry is December 31st. That's when we went and counted the supplies, and now we have to record the expense for the year. So on 12/31, we are going to debit our supplies expense. And we will credit our supplies asset, making it go down. If we debit our supplies expense, what effect does that have on expense? Well, what we know is it makes owner's equity go down, and we make owner's equity go down with a debit. So we're going to record that supplies expense with the debit. So we're going to debit supplies expense by 190 and credit our supplies asset by 190, making it go down. And our description will be to record supplies used during the year. Or you could even make it more simple and say to record supplies expense. You could also say to adjust supplies inventory for supplies used. So again, we have a beginning balance here of 300, which is a debit balance. That is the normal balance of the supplies account. And we went and counted our supplies and determined we have an EB, an ending balance of 110, and we have to figure out if we have a debit balance of 300 and we want a debit balance of 110 to be in the account, because those are the supplies we have on hand, how much do we need to credit the account? The difference between those numbers is $190, so we're going to use that. So this is the simplest of examples, and in just a moment, we will complicate this a little further with some purchases. So here's our second example. So in this problem, we have our supplies account, and it starts out with an $800 balance. So I am going to write supplies again at the top here, and I have debits and I have credits, and I'm told I have an $800 balance. We know that supplies is an asset account. The normal balance of an asset is a debit, and so I am going to put that beginning balance over here on the debit side of the entry. Now, before I complete the T account this time, I'm going to show you something else. It's really, really very logical. If you think about this, if you have beginning supplies, which in this case were 800, and the problem tells us that we purchased 2,100 additional supplies. So if we have our beginning supplies and our purchases, so our purchases are 2,100, and if we use some of them, so what we have available to use is the 800 plus the 2,100. If we subtract out what we used, which we don't know in this problem, we don't know how much we've used, that's what they're asking us to find, but if we had a beginning balance and we had purchases and we used some, we should be able to subtract the used and figure out how many do we have left. In this case, they tell us we have 650 left. Where do they tell us that? In this sentence right here, they said that a December 31st count of the supplies inventory shows that we have $650 of supplies still available. So what we don't know and what we need to know is what have we used. Now, some of you, that may be very easy to do, and you could solve for that question mark or the X. I'll just give you a quick little algebra lesson. If we had 800 plus 2,100 minus X, that's our unknown, equals 650. What we can do to isolate the X is we can add the X to both sides. If we add X over here and add X over here, we would have 800 plus 2,100 on this side. And if we had a plus X and a minus X, they equal 0, so I don't have to put anything there. And we would have, over here we'd have X plus 650, because we added X to this side. And then what we would do at that point is we want just the X to be on this side because we want to solve for it. So if I want the X to be alone on this side, I would subtract $650 from both sides. And what I would be left over here with is 800 plus 2,100 minus 650 equals X. And now we can just simply solve for the X, which I have already done. If I take 800 and add 2,100 and subtract 650, then X equals 2250. Now, let's just put that in a formula that you can just use from this point forward. Our 800 right here is our beginning balance. I'm going to say that's BB. And our 2,100 right here that we added are our purchases. And then we subtracted 650. The 650 was our ending balance of supplies. So I'm going to say that's EB. And that will be our supplies that we used, because that's what we were trying to find out. Our question mark up here was how much did we use. So we can just use this equation going forward. So what we know is we can take our beginning balance of 800, add our purchases of $2,100, subtract our ending balance of $650, and that will give us the supplies that we have used at $2,250. Okay? So I'm going to come over to the T account because I always like to come up with an answer twice and see if it makes sense to me. So we have a beginning balance of $800. That makes sense. If we made purchases during the year, we know what that journal entry would be. If we made purchases during the year, we would have a debit to supplies, making it go up, and a credit to either cash, if we paid for it in cash, or we would, and that would make cash go down, right? If we credit cash, it makes it go down. Or we would credit accounts payable. So if we bought those supplies on account, then we didn't pay for them right away, and we would have credited accounts payable instead of crediting cash. So, so our journal entry would have been, I'm going to erase this right up here and just write in the journal entry. So when we made those purchases, what we would have done was debited our supplies, $2,100, and credited cash or accounts payable, depending on whether we paid it or not. If we credit accounts payable, that makes accounts payable go up. So what we did to our supplies asset here, making it go up, was debit it. So using my T account, I'm going to put my $2,100 over here on the debit side of the supplies account. And then what we determined over here was that we used $2,250. Well, if we use $2,250, then that means our supplies went down, right? We used it. We went into our supply closet and we took out supplies and we used them in our business. And we now have to recognize this expense for that. So what we know is that if we use supplies, our supply inventory goes down. So we would put that $2,250 over here on the right. And then, in order to find out the balance of my T account, I have two debits that equal $2,900, and I have one credit that equals $2,250. So I'm going to take my debits of $2,900, they equal $2,900 on this side, and my credits equal $2,250. And if I want to know what my balance is, I'm going to subtract those two and put it on the number or on the side of my T account that has the higher balance. So I have $2,900 debit, I'm going to subtract my $2,250 credit, and my ending balance, if I do that, is $650. So I have now double-checked my figures because isn't that what they told us in the problem? We had $650 of supplies left. So if we plug our answer over here, our $2,250, into a T account with the other amounts that we know, we can check ourselves and determine whether we are correct or not. So we didn't know what we had used. We didn't know this number. We calculated it. We put it in our T account to double check to make sure we came out with the correct ending balance. We did. So now we're prepared to do our journal entry. So to state this again, when we use the supplies, we have to recognize the expense according to the matching principle and the expense recognition principle. So our date here was 12/31. We never forget to put our dates in. And we have to recognize an expense. And how do we increase an expense? Well, we know that an expense reduces owner's equity. And owner's equity goes down with a debit. So to record the expense, we're going to debit it. And so we are going to call this supplies expense with the debit and credit our supplies inventory with a credit, making that inventory go down. The supplies inventory, actually, I think in this problem we just called it supplies. So I'm just going to call it supplies. But that is the asset account. You could call it supplies inventory if that's what your business calls it. But we have debited an expense, making the expense go up. And we have credited an asset that's called supplies, making the supplies go down. That's how we make an asset go down, by crediting it. So does that make sense? It sure does. We don't have those supplies anymore. And so we put $22.50 in our debits and our credits, and we need a description to record. I'm going to say supplies used. To record supplies used during the year. You could also say to adjust supplies inventory for supplies used. And we have now adjusted our supplies account. Before we made this adjustment, our supplies account had a debit balance in it of $2,900. That's not what we wanted it to be. We wanted it to be $650. So in order to get there, we credited it by $22.50. Okay. Let me just show you one other way to do this. I am really a fan of solving these types of problems with T accounts. So I'm going to draw my own T account. And this is probably how I would solve it. Very similar to what we did. So whatever seems to make the most sense for you. What I would say is, I have my supplies account. And it has a debit balance in it of $800 to begin. And we know we made purchases, so every time we made a purchase during the year, we debited our supplies asset, making it go up, and credited either cash or accounts payable. If we paid for it with cash, and we credit cash, it makes it go down. If we credit accounts payable, because we didn't pay for it when we made the purchase, that makes our liability accounts payable go up. So the debit side of that is to debit your supplies asset, making it go up. So my balance, before I make this adjustment, my supplies inventory has a balance of $2,900. Well, we went in and counted it. We no longer have $2,900. So what we need to do is to adjust this account to what it actually is. This is what it is right now. That's not what it is physically. We went in there and we checked. It shouldn't be that. It should be $650. Well, now that should be pretty clear to you that if we have a debit balance of $2,900 and we want that debit balance to be $650, we're going to need to credit the account in order to make that happen. And then you just simply subtract those two numbers, and it's $22.50. To me, this makes a whole lot of sense. It's very easy to do. I know what it is. I know what it should be. And so, therefore, it's easy for me to figure out whether I need a debit or credit to make it happen. And then I just subtract the two numbers to figure out what it is, what the amount of the adjustment is going to be. And then I use that number up in my adjusting journal entry. Again, what we know is we made the credit. Well, I'll just say, I'm going to continue that. We actually credited that account, but you have to know that the other side of the entry is to recognize the expense, because when you use the supplies, when you purchase them to begin with, you're not recognizing an expense, you're debiting an asset. So you don't have any expense yet until you use it, but once you know you've used it, then you would, then you have to move it out of the asset by crediting the asset over here and moving it into the expense. Debiting an expense increases the expense. Okay, so we have one more example with supplies, and this is actually the easiest one, which is why I saved it for last. So if we have a supplies account that has sorry for that pause. I realized I wasn't on my Blackboard screen. But in this case, this is the easiest of all. In this account, or in this problem, we are saying that the supplies account has a $4,000 balance to start the year. I'm going to go ahead and be consistent with what we did, even though it's not really necessary, and I'm going to show you why here in a minute. So we have our supplies account, which is an asset account. In our T account, we have a debit and a credit side, and debits are always on the left. And we're saying that this supplies account has a $4,000 balance to start the year. That's our beginning balance. What they also tell us is that supplies of $9,400 were purchased during the year. If we assume those were for cash, we would debit the supplies account, the asset account, making it go up, and we would credit the cash account, making it go down. So let's put our $9,400. These are our purchases during the year. And then what it tells us, if we look at the next line, it says supplies used during the year were $10,700. Well, wait a minute. Do I even need to prepare the T account? Or are they telling me what that credit should be to the supplies account? So instead of counting what I have left and giving me this number here, what they've done is they counted what we used and told us how much we used. If they did that, then we don't need to do any math to figure out what we used and what the expense should be. They told us this is how much we used. We don't have it anymore. We used it in our operations, so we need to reduce our supplies inventory by that amount and record the expense. So they have given us this number. It was not a question mark. Okay. Right now, the question mark is what's the ending balance, but we don't need to know that at this point. Although we certainly could find out what our ending balance is. If you'd like to do that, we can say, well, we have on this side $13,400, and we have $10,700 on the credit side. And so this account has a debit balance of $2,700. Okay, so we subtract those two numbers and put it on the side that has the greater balance. Does that make sense? That it would be on the debit balance on the debit side? Well, of course. Supplies is an asset account. The normal balance of an asset account is a debit. If you are tempted to put everything on the other side and you end up with a credit balance in your supplies account, that should be a pretty big red flag indicator that you did something wrong. Because how can you have an asset account with a credit balance in it? Certainly a supplies account, that would mean you had negative supplies. That is a physical impossibility to have negative supplies. So now, since they told us what was used, we can just simply use that amount in the journal entry. In the two that we did before, we had to find out what that number was. What am I going to ask you to do? It could go either way. I could give you the beginning balance and your purchases and the ending balance and ask you to determine how much was used and to prepare the journal entry, or I could just simply tell you what was used. I don't know which one I'm going to do. It could be either. So then we can just use it. If we can just use it, we're just going to come down to our journal entry 1231. It is the same exact journal entry. I have supplies expense that I'm going to debit and make it go up by 10,700, and I am going to credit my supplies inventory, which is an asset account, making it go down, which makes sense because once I use these supplies, I no longer have them, so my supplies, my inventory of supplies does go down, and our description is the same that we've had before. So it is the same description. And there you go. You should be able to adjust your supplies account. Remember, in the prior chapter, we had businesses that were purchasing supplies on account or for cash, and you had to debit your supplies asset and credit cash or credit accounts payable. Then we do that all month long or all year long, but at some point in time, when we're going to produce a financial statement, we have to recognize the expense. We no longer have that supply of assets on hand. We use them, so the matching principle says we need to match that with the revenue that is generated, so we need to record that asset went down and that we now have an expense. And this is how we do it. Good luck. I hope that helps.